So now we have the rating agencies, or at least a rating agency's viewpoint on the European banking system. And I would like to hand over now to Colin Ellis, Chief Credit Officer for EMEA at Moody's. Colin?
Thank you very much indeed, Matthew, and hello everybody. It's great to be with you today, albeit virtually, at another Economist event. What I want to do is just take a few minutes to talk through how we see the kind of resilience of the banking system, particularly in CEE countries and Romania, because what we've heard so far is great in terms of kind of making the structural changes to build green finance and provide the support and take risk out of the market. But the fundamental question really is whether the banking sector is ready to support recovery as and when we see the global cycle really turn and proper recovery take hold from the pandemic really around the world. And I think it's important just to kind of set the scene here, because we all have memories of what happened after 2007, 2008. Our current view is that the recovery from the pandemic will be very slow and very bumpy. We focus on G20 economies and then drill down into other regions and other markets. But of the G20, only 3 countries are expected even to be back where they were at the end of last year by the end of next year. So our 2021 forecasts are for very slow recoveries across most of the major markets in the world, including Europe. And against that backdrop, you might be a bit nervous about the losses that banks will suffer and, as a consequence, their ability to lend into the markets and to support their local economies. So that's part of the work that we've been doing this year. And we've published several reports focused exactly on this. One of the teams that I run at Moody's runs all of our forecasts and stress tests for every bank we rate, all 800 banks globally. And this has been a big exercise for us this year to try and dig into how resilient each of these systems and each of these sectors are. And it's a tricky thing to do, not just because there's a lot of uncertainty about the path of the pandemic and the path of the recovery, but also because in many systems we have seen either support indirectly to households and businesses, which otherwise might get into trouble and otherwise might show up as asset quality problems for banks, or outright forbearance in terms of mortgage holidays and things like that for different borrowers. But our best guess is the impact here is going to be very uneven across different countries around the world. And some places like Mexico and Brazil and even Germany, we are expecting bank capital to fall over the next 3 or 4 years. Now, we focus at Moody's on a tangible common equity metric, so TCE to risk-weighted assets. That's our core capital measure in our scorecards. And there are plenty of systems where we see that eroding over the next few years because of the issues that COVID will present. And of course, that means that those banks will find it more difficult to expand their balance sheets, provide credit to the real economy in the normal way, and fund the recovery. But the good news is, when we look at the CEE region, that's much less so the case. Even under these very trying economic circumstances, our projections are actually for capital ratios in most CEE banking systems to increase over the course of the next 3 or 4 years. It's not true for all of them, but over the next 3 or 4 years, most systems will actually see an increase in capital relative to where they were last year in our base case. And that's coupled with the fact that actually capital ratios in many of these systems were much, much higher to start with than they were in some other parts of the world. So if you look at the likes of Italy or Spain in Western Europe, where our TCE ratios are somewhere between 10 and 13% on average, Romania last year was coming into this downturn with a ratio of about 17.5% in the way that we measure it. So the banks here are starting from a stronger position than many other systems. And we actually think they're well placed to weather the downturn better. And that means they should be able to support the recovery. But just as a note of caution, everything I've talked about so far is really based on our kind of aggregated analysis across banking systems as a whole. As I mentioned earlier, we do individual forecasts and individual stress tests for every bank we rate. And of course, the averages can mask pockets of weakness. So even though you have an aggregate system picture that looks really good, it's still possible for a few institutions to suffer material capital deterioration. And that is the case in CEE. It varies again from system to system, but broadly speaking, we think about a quarter of the banks in Romania are likely to see deteriorations of 200 basis points or more in capital over the next 3 or 4 years. Now, happily, as I said, they start from a much stronger position. And from a policy-making perspective, of course, policymakers are normally focused on the resilience of the system as a whole, rather than all of the individual institutions per se. But it does just point to some of the downside risks that could still be there, even before we get into debates about a prolonged pandemic and how exactly banks will get themselves out of some of the forbearance measures that have been taken. So overall, we haven't taken that many rating actions on banks globally. We haven't taken that many in the region. And that's because we think, by and large, these banks are relatively well placed to survive the pandemic and to support the recovery. But there are still a few pockets of weakness. Matthew, that's probably enough from me for now. I'll hand it back to you.
Okay, thank you so much, Colin. It's good to see that Moody's and the Economist have similar views on the bumpiness and slowness of this recovery. So I think that quite fits in with what we're seeing.